So as you can see, Apple is very resilient. Although we're going through a bear market, Apple is still holding very steady in comparison to most other stocks. I currently own 700 shares and it's about 8% of my portfolio. But say that I wanted to increase my exposure and say you don't necessarily have as much cash that I have in my portfolio. Now this isn't a bad thing. We all have to start somewhere. So what you would do is you would go to trade Apple options. Now I just want to add on top of everyone has to start somewhere. If you have a small portfolio, I know exactly what you want. You want to have huge gains with safety. Well, Leap options are the best way to have huge gains the safest way possible. Of course, you can buy short-term call options, but that's not going to give you as much returns and not as much consistency as buying a Leap option can, and a Leap option is way safer than just buying short-term call options. The thing that I love about Leap options is it's a lot less money up front. A Leap option is something about a year out. So when I go to expiration date, I'm going to pick something roughly 1 year out. Right now, it's October 2022. So I'm going to find an option that's about a year out. So September 15 is a little bit less than a year. It's about 11 months. However, it's basically a long-term option. It's basically 11 months, which is almost a year. So I will count this as a Leap option. Now, for my purposes, a Leap option is really anything over 6 months because most traders are really trading short-term. So anything that is 6 months out is already kind of getting into that medium to longer term horizon. So for me, September 15 is going to do the trick. It's about 1 year out. Now, what I want to do is I want to look at these strike prices right here. I'm going to be buying a call option on Apple. Now notice, if you were to buy 100 shares of Apple, how much would that cost? The answer is about $14,758, right? Because that's 100 shares. But check this out. It's way cheaper to still control 100 shares of stock without needing to pay $14,758 because not everyone has that again. So if I go down here, okay, and I look at the 120 strike, if I scroll down, the delta here, okay, I'm going to explain a lot of this Greek stuff as well, so you're going to know everything. So this is very important. So a delta is how much this option goes up when the stock goes up $1. So say a stock goes up $1. This option right here is going to go up by about 80 cents. So if the stock goes up by $10, this option is going to go up by about $8. And the really amazing benefit here of a Leap option is, like I said, this stock costs $14,758 to buy 100 shares of, but if you buy this Leap option, it's less than $4,000. So it's much more suitable for a small portfolio to buy something for $3,900 as opposed to over $14,000. So here, you only have to pay a fraction of the cost, but you actually still own 100 shares worth of power. And if you do the math, it's pretty simple. You're putting up less than a third of the upfront capital. Like literally less than 30% of the capital up front. But the delta is still about 80%. So you're getting 80% of the same movement, yet about 30% of the cost. So this is a very favorable risk and return metric because you're risking way less and you're benefiting way more. This is actually called stock replacement. A lot of people who are trying to grow a small account should in fact look at Leap options way more than stocks because this Leap option right here is actually very safe. The delta also is the probability that the option will expire in the money. So there's an 80% chance that Apple will be above $120 per share by September 15, 2023. But actually, these options are mispriced. A long-term option is really mispriced because on a long-term basis, the stock market always goes up. The chances for Apple to be less than $120 per share is very low. In fact, the chance is about 20%, according to the Greeks, but in reality, from the research I've done at Goldman Sachs and 2 other hedge funds that I've worked at, the chance is actually much lower, and that's because longer-term options are mispriced. That's actually why Warren Buffett likes to trade Leaps himself. He sold a bunch of put options on Bank of America and other banks back in the 2008 crisis. So for me, looking at the delta, this is good delta. Now, if I take a look at the implied volatility, this isn't very high, and that's fine. Like I said earlier, I'm not really looking for the highest implied volatility. I'm only looking for that if I'm selling options. But here, because I'm buying a Leap option, and I'm trying to kind of replace the need for having so much capital up front, and I'm also trying to give myself exposure into a high quality name. So Apple, Google, all these high quality tech stocks, I would love to do Leap options on them, and Leap options will allow you to have 100 shares, basically worth of control and power, and pay way less upfront, so $3,900 upfront, which means that you can do a lot more with your capital. You can either invest more here, Or my recommendation is, because you're putting less upfront here, so because you're only putting up a fraction of the total cost, you can do this on cheaper stocks, or you can also diversify much better. So even if you're dealing with, $10,000 or $15,000 in your portfolio, you don't necessarily want to have all of your eggs in one basket. You don't want to have too much in one stock. So what you can do, instead of owning 100 shares of a stock, because that gives you the capability of, doing covered calls and other strategies, what you can do instead is replace shares with leap options. And leap options are much cheaper and they give you amazing leverage. So now, really important, what I want to do is I want to show you an example. I'm going to pick the $120 strike price right here, okay? So I'm going to go ahead and buy this. And I'm going to tell you how to manage this position, because I would not hold this until expiration. This option is 11 months out. That's good, right? We have plenty of time. However, I'm not going to hold 11 months. What I'm specifically looking for is I'm looking for a delta between about 0.7 to about 0.85. This right here checks out because the delta is 0.79, about 80, okay? That is really good. Now, with making money, I want to make sure that I hold this option for a good period of time and I don't really lose on this position. My goal is to 2x in about 6 months. Let me show you exactly why it's a 2x and exactly in 6 months, okay? What I'm going to do is, so first of all, I'm going to look at some technical analysis. Let's say that I determined that this stock is going to be about $170 per share. So that's the goal, $170 per share. Now, what I'm going to do is I'm going to wait for this stock to appreciate while I hold this option. So in the next 4 or 5 months, say that this stock appreciates up to $160 per share, or actually $167 per share. So it's going to go up by $20 roughly. So check this out. On a daily basis, the theta right here is 0.03, okay? It's a negative number. I'll tell you why it's negative. Basically, theta is how much this option is losing in value every single day. It's about $3. If you take $3 a day and you multiply it by about 6 months, which is 180 days, you're gonna get 540. This option will decay by about $540, okay? The reason it's going to go down by 540 is because theta is eating away at this option every single day, and in about 6 months, it's going to lose about $540, all things even. Might be a little bit more than that. So let's just call it $550 or maybe $600. So let's just call it about $550 or $600. Now, if the stock were to go up by $20, your delta here is 0.8, which actually means that you're gonna be up by about 0.8 of $20, which is $16 or $1,600. So in 6 months, if you're up about 1,600 and you're down roughly 600 from theta, that means your net gain is going to be $1,000 divided by what you're putting up right here. So you're gonna make a 25% return. At that point, I would do 2 things, okay? The first one is either I would cut this position if I think that Apple is stalling out. If I don't think it has any more room for upside, then I'm gonna cut this position and just leave it at a 25% gain on my money. And basically that's gonna happen in about 6 months. Now, if I think Apple has some more room for upside, I'm not going to close the option. Instead of closing this option, I'm going to aim for more upside. So if this option were to go up to about $177 per share, in that case, I'd be much closer to about a 50% return. So if there is more room for upside, I am going to cut it, but later. I'm going to cut it maybe $177 per share or even higher than that, and then I'm going to target to do this 2 times a year. So 50% 2 times is going to add up to about a 2x return on a yearly basis. This is much easier to scale than just buying shares. Because if you think about it, the stock going from 147 to about 177 isn't that much upside. It's only a 20% return. However, you're making a 50% return. So basically, you're getting 2.5 times leverage or 2.5 times the return. You're actually putting up less risk up front because you're putting up less of a dollar cost up front in capital. For me, doing leap options on Apple makes a lot of sense rather than owning Apple shares. I think this strategy can return a lot higher than just owning stock outright. I actually think you can manage your risk very well by cutting this position when it reaches $167 per share, for example, or on the flip side, say that Apple is going to pull back. If it pulls back by about 10%, you can actually set a stop loss. So if Apple were to pull back by about 10%, you would lose roughly the same amount. However, that amount will be on a lot less money up front, so you would lose less money than a stockholder.